Joining us now is Hedgeye senior macro analyst Darius Dale. And Darius, we all pointed out that, like Keith McCullough, you have a notebook. Yours is not
like father, like son.
Yeah, yours is not as like crazy and scary. And I'm living up in the woods in Montana somewhere alone, plotting my takeover of the
backwoods of Westport, Connecticut.
Exactly. But you guys, let's start with oil. And I know Scott has a question about this. I know you're bearish on the economy. You're bearish on stocks. So are you guys bearish on oil as well here?
Well, certainly. I mean, deflation should continue to persist as long as what we initially identified as the G3 policy divergence should continue. Now you can throw in the BOE in the UK and China, the PBOC in China, and you have a sort of a G5 policy divergence where you have the Fed on one course and really all the other major central banks on the other course. And the net result of that is that the U.S. dollar should continue its ascent higher, which is a very deflationary sort of impetus on commodity prices.
And that being said, for the average viewer, somebody who's just checking in on their treadmill or something, when is it appropriate, or is it time to buy oil stocks or oil-related, pipeline and transportation stocks?
Or even energy-related high yield at this point.
I don't think those trades are going to unwind at any time soon. You'd really just have to get this dollar sort of off its high horse. And we don't really see that happening in the context of that divergence theme we have. But again,
so what do they do? Just kind of hang and do nothing?
No,
you don't have to buy. That's the thing. No. It's like you don't have to buy energy.
You don't have to run out and touch somebody every time you see a stock flash on the screen. I mean, look, we could be saying this all year. If you're a long-only investor or an investor who's predisposed to be long equities, you can continue to high-grade your portfolio. What we continue to see is the biggest risk to the economy now. Deflation was the biggest risk last year, but growth, we think, is the biggest risk heading into 2016. So you want to be high-grading your portfolio, and that means high market cap stocks, low leverage stocks, low short interest stocks, low beta stocks, and those things have materially outperformed their counterparts in the year to date.
I want to get some names real quick, but Phil, because Darius is talking about the divergence in central planning, central banks with the Fed versus everybody else in the world, essentially. So the dollar strengthens. That's tough on oil, but you also have a lot, as you pointed out, a lot of other factors weighing on the cost of crude.
You do. You have a glut right now. You have OPEC signaling that they're going to continue to produce oil. And Darius is right, though. If you look at the biggest moves in oil over the last 10 years, they've been central bank driven. QE drove the price of oil up. The inverse of interest rates now is driving it down. But, the question is, when is it going to turn? I think it may turn faster than people think. Maybe mid-year. Listen, we've been doing a lot of anticipation. We knew that we're going to see more QE out of China and Europe. We've known that the Fed was going to raise interest rates for some time. I think a lot of that's priced in, and even though we'll see that trend continue, I think it's getting to be a heavy trade, and it could change.
Super high quality stocks. I know that you guys are fans of McDonald's, but yes, what else? Throw some other names out there.
Eating there or buying?
No, owning the stock. They're bullish on McDonald's.
McDonald's is a great company and they have great food, but I wouldn't necessarily recommend eating there.
But you can still own the stock.
No,
two health nuts.
Absolutely. McDonald's and General Mills are two stocks that really fit the style factors that we're looking for here. Again, you want to be high market cap, very large cap stocks, low leverage, sort of low beta, and very low short interest.
So does the Fed raise interest rates again, do you think, this year?
They're completely out to lunch with respect to their economic forecast, so probably. But again, we continue to see.
How do you think that affects your overall projection?
Well,
it's likely going to make us more right. It's going to make us incrementally right on the deflation view, and it's likely going to make us incrementally right on the growth slowing view, which we continue to think a recession has a high and likely probability of commencing by the middle of next year.
Joe?
What about consumer tech-related stocks? I know there's a lot of interest in investing in companies like Facebook and Google who have performed so well.
Yeah.
What's your take on that for 2016?
I mean, chase the FANG until it breaks. When the FANG breaks, it's look out below for everybody.
Tell people what FANG
this happened in 2007. It happened in 2000
FANG
with
is Facebook.
CMIQ. It happened with the Four Horsemen in 2007. You see narrowing market leadership at the end of every economic cycle because you just run out of stocks to buy.
FANG is Facebook,
Amazon, Netflix, and Google. Alphabet.
Let's instead of the A for Amazon, Apple. That's a trip to Steamtown this year.
Apple.
Yeah.
No. Let's make it Amazon since Amazon's done well and Apple's taking a trip to Steamtown.
Well, you find out what happens when growth slows. I mean,
this stuff.
Apple is a very classic sort of growth slowing stock. You miss numbers, your margins contract. When revenue slows and margins contract on the margin, if it's a loved stock, it goes down a lot.
But what about Apple bringing out new improved products in March, June, fall of next year? Can that help?
They did that this year, and they'll do that again next year, and they'll do it the year after.
Right.
It's all about expectations and the rate of change in the key metrics.
Not good enough.
Absolutely.
Is
Not
the
good
key
enough.
actually to get a couple of stocks that you actually like, put in a price point, put in an order, and just wait there. If you get it, you're happy with that number regardless, and then knowing it's a long-term potential buy for you?
Yeah, I mean, look, I think if you can just maybe have the producer put up like a 15-year chart of the S&P or something, what does long-term buy mean? I mean, the market could cut in half, and that would be a pretty normal economic cycle from here. And so that's we're not necessarily making that call, but that's a key risk if you just look at that chart.
Wait, are you guys bullish on treasuries, like longer-term treasuries, even with the yields where they are?
I have one position in my PA. It's my entire PA. It's long-term treasury bonds.
And that is the one thing that people have gotten wrong and wrong and wrong and wrong, except for you guys since 2008.
Yeah.
Everybody, once we were after the crash, everybody thought it was going to be runaway inflation. It was going to be crazy long-term interest rate increases.
You have to get the slope of the 10-year Treasury yield and yields a lot further out on the curve track the slope of economic growth like a glove. If you get growth right, which we've been, knock on wood, been fortunate to do over the last few years, you're going to get the rate of change in the Treasury bond yield, correct?
Darius, great to see you.
Thank you.
Darius Dale, Happy New Year. Come back more often. We don't see you enough.
Like
No, we don't. I love Keith. I love Keith.
Thank you.
I know. Keith needs to give you some work on your notebook. You need to make it crazier. Thanks, Darius. And Phil Flynn, love you much. We'll see you later in the week.